Hi everyone, good afternoon. Thank you for joining today's webinar. Yeah, you can post on the comment section, tell us where you're joining from. Are you joining as a lender? Are you joining as a customer or a credit risk personnel? Thank you so much. I have someone here joining from Lagos. Please keep it coming. Wow, I have a customer here. Thank you for joining today's webinar. Thank you for joining. Stephen, thank you. You're welcome. You can also tell us your expectations for this webinar. Okay, we have a lender in the house. Thank you for joining. Tell us what you expect from today's webinar. John, you're welcome. Okay, we have someone here from Ogun State. You're welcome. Thank you for joining. All right. We are looking forward to that too. Thank you so much for coming. Thank you for joining. Please keep the comments coming in. Adenike, thank you for joining. You're welcome. Let's keep it coming. I'd like to see more expectation. What do you expect to get from today's webinar? What are you looking forward to? Please keep it coming. All right. Thank you for joining. You're welcome. Looking for more insight in the credit space as a consumer. Wow. Adetutu, you're welcome. Thank you for joining. Thank you for joining. You're welcome. Good afternoon, everyone, and thank you for joining us today. My name is Mary Inesi. I'm the credit risk manager and product owner at Vind, and I'm delighted to welcome you on behalf of Vind to this important conversation on practical risk strategies for lenders in the limited credit data environment. As lenders in Nigeria and across Africa, we all share similar challenges. Is it credit bureau coverage that is still thin? Many borrowers remain invisible, and traditional risk models alone just don't cut it. Yet, despite these hurdles, there are exciting opportunities to use new data sources, smarter processes, and technology to grow portfolios responsibly while keeping non-performing loans under control. Our goal here is to share practical strategies that go beyond theory, things lenders can actually implement to reduce default, grow your portfolios responsibly, and also protect your profitability. Which brings me to our guest for today. We are honored to have Michael Adetutu, the Chief Risk Officer. He brings a wealth of experience in credit risk management, financial services, and technology. He has worked extensively with financial institutions on designing credit strategies that balance growth with portfolio health. And I can't think of a better person to help us unpack today's topic. Please join me to welcome Mr. Michael Adetutu. Michael, you're welcome.
Thank you very much.
Thank you for
I'm
joining today.
delighted to be here.
Yeah, how has your day been going?
Well, my day has been going fine. There's always risks in everything you do. When leaving the house, you are facing risk, and even at work. So, and that's the lovely thing about our job. Uh, you find out that there's no two-way things of doing the same thing. So it keeps you just keep getting a lot of things coming your way, and you just have to find a way to mitigate them. So thank you very much for having me. It's very,
Thank
very,
you.
I'm honored to be here.
Thank you so much. Okay, let's get right to it. So let's give context to the problem here. In your experience, what are the biggest pain points lenders face when relying solely on credit bureau data in our markets?
Okay, so in many part of the world today, lenders face what we call a paradox. And there are millions of people, businesses, eager for credit. Let me put it that way. They are really eager for credit. Yet traditional credit histories, credit bureaus still are missing or unreliable at the moment. Kudos to the credit bureaus that we have in Nigeria at the moment. They've been doing a wonderful job by sending daily reminders for institutions to report their data to them as fast as they can. I believe one of the things they do is remind every institution that you have to report your data fifth before the fifth of every new month. However, there has been some pain points on the unreliability of credit bureau data, which is actually not coming from them. A few is not coming from them, largely, based on the current macroeconomic variables we find ourselves and the fact that data is something we've accepted in Nigeria, but still in a snail-like pace. So one of the pain points is over reliance on this credit bureau's data. You find out that most credit bureau data are backward looking in a way whereby it talks about just the historical characters of most of these individuals or businesses. And if you want to really lend and be at par with top lenders across the Europe, Nigeria, and the South Americans, the North Americans, you have to always be forward looking. So at the moment, our credit bureaus at the moment is a bit backward looking, but they are really working hard, to make sure that we have a good data. And another pain point that comes into mind is a tin file. I call it tin file borrowers. Most of financial institutions tend to lend to specific individuals, removing other kind of demographics in place. One of them is young adults.
Mhm.
You find out that if you go to the places of, let me use an example, Canada, whereby you have student loans. And in Nigeria, we thank God that student loans are coming in, but this kind of data are not well represented in our credit bureaus. And so taking an informed decisions about young adults, like entry school leavers, people that have not taken credit before, might be a bit worrisome. And same thing applies to migrants as well. You would see that most institutions in Nigeria will tell you, I don't lend to a non-citizen, a migrant, but there are ways you can always go about that as well. There's small businesses, that are not registered. Another thing again that might put us that might be a pain point is the bias to new borrowers.
Okay.
So there is this bias that if you are new to credit, you are high risk.
Yeah.
Yes, it is one of the biggest bias that we have in mind. That if you are new to credit, you are high risk. However, there are ways you can go overboard about that. New borrowers shouldn't be. Yes, it's left for you to raise an eyebrow and said, "Oh yes, I don't know who this person. This person doesn't have credit histories." Even the developed nations would request for your credit profile to see your histories. So most times it's always you raise an eyebrow, but at the same time, there are ways whereby you can lend to them, and you find out that new borrowers are even they are much better than the old borrowers because
Mm-hmm.
the borrower seems to know the system more than the new borrowers. You see an old borrower telling you, quoting the FCCPC guidelines to you, quoting the CPD guidelines by CBN to you, and you find out that by the time you want to recover from such individual, probably they are defaulting. They are telling you cannot do this and recover from it. So it makes them number one huge defaulter, but not removing the borrowers. It's one of the major pain points that we see. And lastly, one of the pain points that I can put in mind is also over reliance on the credit bureau, and it creates what we call concentration risk. When you have over reliance on credit bureau, company A is over relying on the reports credit bureau is giving, company B is also relying on that company C and D, and you find out that every company that is over relying on credit bureau without having other form of checks tend to be concentrated in a risk whereby everybody makes an informed decision on what they see. So those are just a few pain points about the credit bureau data that's affecting our credit our market at the moment. There are many other pain points, but I think I'll stop at that.
Wow, thank you so much. That's very informative. And you've even been able to tell us why many potentially good borrowers remain invisible to our traditional credit system. Can you share an example of how limited data has led to either poor lending decisions or missed opportunities for lenders?
Okay, so answering that question, I would paint a scenario.
Okay.
In one of the places that I've worked, we had, and I will not mention the company because it's one of the biggest, is one of the biggest financial institutions that we currently have. So this person came to us, and he was new to credit, but he had this lovely idea, and he was trying to bring the idea to light. He had somebody that could, provide funding for him. And so he brought this idea and said he wants to lend. He was a salary earner before. He wanted to go into business. He was willing to make the loan secured with his two of his vehicles. But because, if you go back to what I said recently, because he was new to credit, there was a bias already. But I saw the potential in what he wanted to do. But irrespective of seeing the potential as a risk person, you also have to be intuitive. Uh, as somebody, as a risk person, also have to deal with facts and data, irrespective of you saying, yes, I see the future in this person like a pastor, but you also have to go back and say, what is the data giving me? So because he was new to credit, the the product he was trying to bring out was a risky product that eventually, if it was accepted, it was going to be a big changer in the Nigerian market. But if it was not accepted, it was going to be another loss. So because of that, I did my CAM, my credit assessment memorandum, I did my underwriting memo, I did everything I could to make sure that you know put every risk that might emanate from the transaction. But based on the topic of this webinar, he was not given that facility. And reason being the fact that he was new to credit, there wasn't any data about him doing something or lending before. So it was a basic risk. And I can tell you today that if the company I worked for back then, if they had granted him this credit, they'll be into the bank because this person in question has been one of the biggest financial institutions. In fact, this person in question is competing with commercial banks at the moment
Hmm.
and bringing of products that you can ever imagine. So I think I'll stop at that. Thank you.
All right. That was so informative. This bias is really a thing, and that's one of the things Vind is looking into achieving to provide credit solutions to everyone without the bias. Okay, so we'll dig right into the solutions. If credit bureau data is not enough, what alternative data point should lenders be looking at?
So yes, I think that is one of the follow-up questions that should come. So if credit bureau data is not enough, what are the other alternatives that you can use? This is not disregarding credit bureau data. In fact, credit bureau data puts you at a certain percentage of making an informed decision. However, one of the other things you could look is transactional data. And
Yes.
when you're looking at transactional data, you're depicting the inflows and the outflows of that individual or the businesses that you want to give or you want to lend to. And that would give you an informed decision of the capacity of that individual or business. In this context, let me say an individual. And transactional data would not only give you the income or outflow of that person, you could as well depict a lot of average balances. You could see bill payments that come in place. You could see a lot of things. It's more like if you see a credit underwriter that has been in the business for a long period of time, and I've worked with a few. I was a staunch credit underwriter, and kudos to one of my major boss back then, Richard Rotoye. If you see a credit underwriter, that person can tell you the life of that individual by looking at the transactional data of such person. You can tell if the person is a gambler. You can tell if the person expend anyhow. You can tell where the person stays. You can tell a bit of the life about that person when you look at the transactional data. But moving on, you can also look at the recurrent payment behavior. For the likes of us that like watching the big N, sorry, I'm not being paid for an advert, but I like I likes watching the movie part that has the big N, you
Mhm.
would see that there's some sort of recurrent payment and possibly for internet services as well. So that can give you an informed decision of how committed that person is in terms of recurrent payment. Some people will argue and say yes, that because their card is tied to it. But that's the same thing that applies to repayment as well, using either ZGP or the pay stack model or card repayment model. Another thing we can also talk about is remember I said in the context of an individual is the employment or salary, the salary that comes in every month. You would agree with me that it's an high risk when you want to lend to somebody that gets a salary today. In the next 2 months, you are not seeing any salary. In the third month, you are seeing salary. The fourth month, you are not seeing anything. Such persons, you'll be very scared to lend to such persons, and that person would not just be put in high risk. Depending on your risk category, you want to put that person in very high risk. So, also behavioral data can also come in place as well in terms of application data. And let me say this: there's a good way you can determine the futuristic character of an individual through his application form. And that's one secret that I've learned. And in blessed memory of one of my former boss, Chidima Oyekoro, there's something we call psychometric.
Okay.
And You would ask customers to, take answer some things, but it became cumbersome, and that is why technology is lovely. But you find out that you can infuse those little questions in their laugh. Laugh means the loan application form. You can infuse it in the application form. And with that, with the current transactional data, with the historical one, which is the credit bureaus, and the questions you've technically imputed in the application form, you can be able to determine or use a psychometry to determine if such individual would repay you in the future. Most often than not, it helps in determining, it helps in reducing default rates. So I think those are just a few amongst it. Then there's telecom data as well for the app based interface. There's telecom data whereby you're looking at with the consent of the individual or the consent of the app. You're talking about SMS and email scraping. You're looking at the SMS, you're looking at the emails, you are determining what airtime the person makes every month, you are determining the customer data through his app. So these are few data points that can assist in an alternative to credit bureau data. Thank you.
Thank you so much for giving us that secret. Okay, so in your response, you've been able to tell us how we can infuse technology. Can you tell us more on how technology can help lenders pick up these signals in scalable and automated way?
Okay, so number one is application program interface API.
Okay.
So one good thing in Nigeria today or the past few months, that is one of the things that is going to change the shape of financial institution, especially the fintech space. And please, I stand to be corrected. Commercial banks at the moment, deposit money banks, they tend to keep their data. They tend to like know they cannot compete with the commercial bank likes, and I understand their I understand them because you have series of things to do there, and they have a lot of data. They have a lot of things to come up with, and they have a lot of products. But at the same time, sharing data can be cumbersome and be like, why should I share my data when I've worked hard to get this?
Yes.
Good thing is the open banking um, that is currently ongoing. And last I remember, it was supposed to be out by September, but I don't know. Maybe there are still some frameworks to be put in place. So open banking is going to help many financial institutions whereby there will be this sharing of data. So moving on, application program interface API is one of the technological things that can help lenders, connecting to from your loan origination to your disbursement and post disbursement. And this means you can use the API connection to identity companies or KYC verification companies, whereby you verify the identity of such individual. You can use the OCR model to pick out the optical recognition, character recognition model to pick out IDs that have been or document that have been uploaded to your platform are based either web or application interface. So with that, you'll be able to determine if there's some sort of identity theft. Even liveliness checks is part of the technology that you can use API to call out. Then secondly was in terms of bank statement as well. There's this the two major ones people use currently right now, which you can spool people's bank statement from the comfort of your office, either through your app or your web interface. And with that, you can the customer doesn't need to come to your office to give his bank statement. I remember back then when this hadn't come up, yeah, you'd see hard copy bank statement, and you'd take the hard copy bank statement to the bank to go and do verification, work under the sun. And these are lovely times because it showed me how my growth has been. But with these APIs, you can do a lot of things. Then another thing is advanced analytics and machine learning. And Machine learning is one good tool that it helps in lending. It creates pattern recognition. It even gives you a predictive model and say, oh, this is how this behavior of this customer would be, and it helps in risk-based pricing and decision making. Another technology part is, you can have credit decisioning credit decisioning tools like that that can help you in your credit scoring. You have decisioning models that have been infused with machine learning as well, that can help you dynamically score a customer and tell the customer, and you would know if the customer falls into a particular risk category or not. Then scalable platforms like CBA, core banking application softwares, trust me, would help you do more than what you've ever thought of. It helps in the automation process. Anyway, technology allows lenders to see more than the human eye. Let me put it that way. But it creates patterns. It creates dynamic way of you lending to individual and more faster with accuracy as well. Thank you.
Thank you so much. That's very enlightening. So let's talk about early warning systems. What are some proactive ways that lenders can spot repayment risk before a loan goes bad?
Okay, so the first thing is real-time monitoring.
Okay.
So real-time monitoring is one of the ways you can spot that before a repayment goes bad, before a default hits.
Mhm.
Uh, there's something most of us do wrongly is creating a credit decision at the beginning stage, which I'll still discuss much later. I believe so. Yeah, maybe in the course of this webinar. So what I mean by that is at the loan origination stage, you have already profiled this customer. The customer is profiled, let's say, under risk A, depending on the kind of model that you use, and that shows that the person is a low risk customer. When that is being done, what most of us fail to do is continuous scoring. And for example, I go to institution, they looked at my profile. Oh, he's a chief risk officer. He has this, he does this, he has his house, he does a lot of things about me. And so, oh, because of this, I earn 100,000. So his risk category or profile is a low risk. However, in the course of me taking their facility and I keep repaying and I default, if you go back to check a few people's system, it still carries that low risk. Instead of that, what the system should be doing is should be rescoring you based on your current repayment pattern, based on your conversational style with the company, based on your current profile in terms of your age. You've added 1 year today, you're moving towards retirement. It should be rescoring you. And so those are one of the proactive models that you can use to determine default. And second thing is portfolio analysis. When you carry out portfolio analysis, you'll be able to determine if such individual or businesses should be given a facility or and should be able to determine if there'll be a default that might come out of it. There was this time that a sectorial analysis on that portfolio was done and say there's this sector of people under this industry are prone to default. And lending to them is high risk, which means that if you lend to them, use a risk-based pricing model, use a risk-based pricing decision or risk-based decision to lend to them. And once you do that, you'll be able to, avert a bit of default. And there's some location analysis. There was a time that we all know that lending to people in the Apapa zone was high risk, especially the people that are in, we call them Snake Island. You cannot even go there to go and say you want to pick a customer to repay. They won't even allow you go in. And so lending to such person is high risk. If the person doesn't repay you, you would send call the DCS, the debt collector agencies. They will try to go there, and at the point even lending to some sort of uniformed men was a bit high risk as well. But you find out recently that uniformed men are even more disciplined when you report them. You can get back on. So these are part of the things that are proactive measures. And again, it's customer engagement triggers. So what I mean by that is how well have you been sending notification messages to your customer? How well have you pick your phone on a cold call and call your customer to know what your customer is going through? How well have you been sending that reminders at due time to know when the customer will repay? A good thing that I developed recently was we call it collection triggers.
Mm-hmm.
It's email, in-app notification, SMS as well to that customer in due time. There are days different. And you find out that that collection trigger that I did is different. Like if you and I take a loan right now, the same loan, we earn the same salary, but our risk profile is different. So the collection trigger notifications I'm sending to you will be different from mine. I might have the kind of tone of my trigger will be different from your tone because of your scoring, because I have put you in a place whereby I'm scared of the fact that you might not repair. So there are a lot of things that you can do stress tests on your system, do stress tests on the products you've done, do stress tests on customers as well. So that will help you to proactively, waive default risks that may emanate in the future. Thank you.
Thank you so much. This just goes to say that a customer in group A, which denotes low risk today, can become high risk tomorrow if not properly monitored. And someone you term as group C, which denotes high risk today, can tomorrow become medium risk or even low risk tomorrow.
Very
Okay.
correct.
Yeah. So I do hope everyone here is learning, because in fact I'm getting new insight, new information, and I'm so excited. Thank you so much. So in many institutions today, credit assessment still feels very manual and slow. So how can lenders strike a balance between empathy and automation in their credit processes?
Okay, so credit institutions still feels manual, slow, um, and you have to always infuse technology into what you do as well. So, like I mentioned earlier, you always have to. So, there's something that I do most times is irrespective of automation in place,
Okay.
you can never take the human intuition out of it. Machine learning will give you almost a predictive model and say, oh, this person will default. And eventually, the person might not default. And you would also find out that human intuition is a big key here. So infusing both traditional and infusing both traditional automation goes a long way. But trust me, you always have to do more of the automation than the traditional because there are many lenders in the market right now, and one of the things you are selling is a service. How fast is your service? How reliable is it? How customer friendly are you? When you do all this, it puts you at the mark of, getting more customers. So back to what I was saying. Yes. So traditional credits over time has grown, and a lot of automation has come in place to well assist in creating more avenue for lending. And the informal industries, which takes about 58% of the GDP as of 2024, still accounts for the fact that most people of those informal industries still prefer the traditional aspect. But now, bringing back it's one of the major key thing about this is awareness and training.
Mm-hmm.
And you would correct me if I'm wrong. Okay, let me give you an example. I remember speaking with my dad, and my dad will tell you, you still see some people go to the ATM and they would want to impute their PIN. They will look at your back, look at the front, look at the side, and say, I don't want anybody impute seeing my PIN. And someone like me will still make use of it and impute my PIN. And the first thing that comes into my mind is there's two-factor authentication. And another thing is if you can get my card, then you can get my PIN, things like that. So infusing both goes a long way. And I would say this that when you are building your systems, you should please not remove every form of intuition, a bit of traditional, because that is where BCP comes, a business continuity plan or a disaster recovery plan. Sometimes technology can fail today. So how well do you want to recover and continue that process? And so always leave a room, a 1% room for such what would I call it, for lack of better word, disaster that might happen. So I think that's just the summary of what I would say.
All right, thank you. Okay, so what role do tools that can flag key-risk signals in real time, say from bank statements or repayment patterns, what roles can these tools play in strengthening underwriting decisions?
Okay, great question. What role is it helps in improved accuracy?
Okay.
So in terms of you want transactional data, like I mentioned earlier, the role of bank statements, the role of repayment patterns and the likes helps in improved, accuracy and depth of risk assessment. You can carry out an in-depth risk assessment when you have such in place. Then another thing, it helps in accelerated decision making.
Okay.
So you have an accelerated decision making, and when you have an accelerated decision making, if you remember, I said something that my former boss used to say something that I want this done, but it will tell you I want speed and accuracy. That is what it's going to tell you that irrespective of the speed, there has to be some sort of accuracy. So it helps in accelerated decision making. Another thing again that can assist is enhanced fraud detection. Okay, so I'm going to go back to what I said earlier that I remembered back then that you have to customer will print the bank statement. You have to now take the bank statement to the bank. You queue with the long queues at the customer service section for them to verify if the bank statement is original. They'll start looking at the They'll start looking at all the entries on the bank statement to say, oh, yes, this customer received this amount, this customer did not receive this amount. So, because of that, there are some certain banks will tell you you can't do that without the consent of the customer. Then the customer writes a consent letter to you, and I take the consent letter to the bank again to go and reprint at the customer's expense. And when you now reprint, you now find out that, oh, this customer is lying, or you cannot go ahead with this transaction. You may eventually now say, I want to decline the transaction and the customer spent. So with that, it helps with enhanced fraud detection with the new tools in place whereby you can sit at the comfort of your office and get a bank statement by yourself. Because back then, banks will tell you they cannot send what did they cannot send you the bank statements as a third party person. But right now you can tell the bank, I walk up to bank and say, send my bank statement to this email, and
Mm-hmm.
put me copy. So it has helped in enhancing fraud detection, but and also it helps with proactive risk mitigation. You have a lot of assessment to do, mitigation in terms of identity, mitigation in terms of fraud, mitigation in terms of decision making, wrong decision making, operational risk, it has to do with human error. So these are a few things, and not for us not to forget. Also, regulatory compliance must be put in place as well. It helps with regulatory compliance, being in line with whatever license that you have, being in line with the permissible and not permissible activities of whatever license you've gotten, and keeping toe to toe and not missing out any regulatory infractions that might come in place. So I think that's just it for now.
Um, so all in all, you still need, for TAT. I remember in my experience, I've gone from credit decisioning that takes hours to minutes, and that's what Vida does. It does not rely solely on credit bureau data, but also uses alternative and transactional data to give you more insight into a borrower's credibility, and it's within a short period of time, and you can just make your decision. Thank you so much. So we'll be talking about portfolio health and NPL reduction. If you have questions, you're in the audience, you have your questions, we will get to the Q&A session. Please, you can start dropping your questions. Thank you. So a lot of lenders struggle with reducing NPLs once loans are already disbursed. From your perspective, what practical steps can be taken at origination that can significantly reduce the risk of default later?
Okay, so good one. The first one is to me go beyond credit bureau data, right? And combine the credit bureau data with the transactional data. So most often than not, we have lenders. The first thing they do is, oh, okay, Michael wants to take a loan. Let me first of all check the credit bureau data. Oh, he has defaulted. I defaulted in 2010, but this is 2025, and because of that, you find out that some institution will tell you they won't lend. But funny enough, you can lend to such individual. And there's something that, like I always refer to my supervisor back then because he was the one I really learned from. There was something we started building, it was called credit building. And credit building helps people that have defaulted before to help them rebuild their credit. It takes a lot of information and parameters, but it put them back in a map of building their credit. So go beyond the credit bureau data and infuse it with transactional data in order to determine if such persons can accept the loan. It will help you reduce the NPL. Then another thing again is calibrate the loan size. So what I mean by that is you have an individual that wants to get a facility, you can decide not to give him that full facility based on his risk profile. And this is where you now start infusing what we call DTI, debt to income, or TSR, debt to service ratio. For the business guys, you can do PTI, which is payment to income. And there was one major thing to put in place is affordability model. Going back to the example I gave earlier, that I might be earning 100,000, I might be a chief risk officer, I might have children, I might have my house, stable. But at the same time, looking at my transactional history or my transactional data, you found out that I sleep in hotel, I play betting, I drink a lot. You are seeing me in the bar from now to tomorrow. So with that, you create what we call an affordability model, and that affordability model would help you determine, can this person take this loan? If we give him the, can he pay back? So you are already not looking at the current state of the loan you want to give. You're also determining if this will hit your NPL, if this will, go into your NPL in the long run. So those are one of the things you can use in reducing NPL. The second, another thing is keep trace. Most times you find out that keep trace is always done after you've given the loan when the person defaults. Then you start going online, doing skip trace. Or this person is in Maryland today, or tomorrow this person is in Texas, or tomorrow this person is in New York. So, but you can start your skip trace at the origination stage, and that is knowing who your lender, knowing who the customer is. When you do that at the origination stage, you can proceed to, you know, make an informed decision and say, okay, Mary sleeps in Maryland. Tomorrow, Mary sleeps in VI. Next tomorrow, Mary sleeps in Surrey, and you're wondering why is Mary sleeping everywhere? So if I give Mary this loan, and if Mary runs away, I won't be able to know where Mary. So those are part of the skip trades you can do. Then you can find early trigger signs. I remember building one thing we call red flag manual, and that's I keep improving on it every day, and it's a robust manual that can is a trigger that will tell you if you see this, put an eyebrow on this. Then, most importantly, invest in your staff. Train your staff in the right way. Training your staff when you need to is a key thing in reducing NPL. Not just teach your staff on how to do end-to-end finish. Like one of my CEOs will say, he's a document verification officer. Train your staff to see beyond your risk acceptance criteria, to see beyond the reason why you are asking that, oh, for this customer, you need these are the list of things you must get from this staff, I mean from this customer. Train your staff to train your staff to see beyond why should I why am I being asked to get bank statement from this customer? Why am I being asked to look at the credit bureau of this customer? So those are the things, the few things you can do, amongst many other things. I believe there are a lot of risk professionals here that will even score me under more things to do. Yeah, thank you.
All right. Okay, so at certain points, certain some lenders consider rescheduling or restructuring. So where is the line between helping the customer and hurting your portfolio quality?
Okay, so yeah, um, rescheduling sometimes is quite very good, right? But there is a thin line there. You wouldn't want to reschedule a customer's defaulting loan. You wouldn't want to reschedule a defaulting customer who you cannot find. So,
True.
so I'm going to cover the banks. It's a commercial bank, and I was opportune to meet um, their chief risk officer at a point in time. So what they did back then was because they had a lot of NPLs, right? Then I started rescheduling their loans so that I can put the company back, the state of the NPL into a very good state. So they were rescheduling, but however, it will still catch up. That's one
Mm,
mistake, obviously. But there are some things that you have to do, when rescheduling. It's, you can determine what we call early intervention workout. A customer
okay.
is telling you that a customer has already reached out to you, or you're seeing the repayment pattern of that customer that is not paying as well as he should. Is the customer's repayment is 100,000 every month. The customer paid today. The customer did not pay the next month. He paid the third month, and with that pattern, you'll be able to decipher and say, okay, maybe this customer is constrained with the repayment. And what you can do is, you know, um, the early intervention workout is, contact the customer and have a discussion with the customer. Why is this repayment pattern different? And when that is being done, the customer might open up to you and tell you that my expenses increased and I'm unable to be paying 100,000 monthly. And that is where you can now reschedule and say, you know what about if I reschedule to a higher tenor and so that you can repay at this certain amount, but there is a cost to the reschedule, and the customer would agree. Someone that is paying 100,000 and you end up start paying for 40,000 every month, but at a longer tenor, that would help the customer. I think, and there are some other ways as well, but I think I'll stop here because of time.
All right. Okay. The next question. Do you believe that most defaults are recoverable with the right strategy, or should lenders just prepare for a fixed percentage of loss no matter what?
That is a very tricky question. So, yeah. So in reality, let's just be honest, because I can from the comment section I can see a lot of risk managers there that would that would call me out and say, Michael, but in reality, not all defaults are recoverable,
Okay.
right? Not all default recovery. But what you can do is put an effective strategy in place, to substantially reduce your NPL. And one of the few things, like I mentioned, is early intervention workouts, whereby you contact the customer and see how you can, then how you can reduce the repayment pattern. Then another thing is advanced collection tactics.
Mm,
This is where you have your field recovery guys. This is where you have the DCAs. That is where the advanced collection tactics comes in, so that the defaults will not be shooting the roof. If it's a secured lending, you can use the assets the person would have given to you as a collateral, to to bring down the default. But one thing, then rescheduling and
Mhm.
restructuring comes in place as well. But you can also introduce what we call early incentives for early repayment. And so what I mean by that is you have a 12-month loan, and I'm telling you that, okay, already seeing the pattern, and I'm telling you that why don't you, if you repay early at this certain percentage, have you repay early at this certain time, have the ability of removing a fraction out of your interest.
Okay.
And let's trade open. If you have a loan running right now, and I'm saying you receive salary 25th of every month, and I'm saying if you can repay your loan on that 25th of every month, for every time that I charge you 1% interest every month on your loan, I'm going to charge you 0.95 on it, and
Mm.
you're going to save. So I know your salary date is that particular day, but it also helps you to say, it also help you to wave off the thought or mindset of saying, maybe this month I don't want to pay. So, but it says, oh, if you pay, I'm saving more money. And
Mm.
then I think those are just, then lastly, have a fixed percentage of loss.
Okay.
Say, this is my fixed percentage of loss that I want to have in my books, which will not be overboard the prudential guidelines or the provisioning of the CBN or whatever licensing you have, but have a
Mm.
fixed percentage. Say, this percentage, I cannot go overboard this percentage. So, which will now determine your risk appetite of the organization. I think that would be all because of time.
All right. Let me give our audience one expo. Don't say you didn't hear it though. So there's actually a tool that you can use to increase your chances of recovery by a great margin, and that is Vida. You can use Vida for your recovery activities. It gives you access to accounts, other accounts of the customer aside the salary account. Don't say you did not hear it though. I have told you.
I've written it down as well.
Okay, so we're getting closer to our Q&A. For lenders listening today, if you could give just one practical risk strategy, just one, that you should start implementing tomorrow, what would it be?
So, one thing I will tell a lender today is do not do underwriting as a one time event.
Mhm.
Meaning that because you've done underwriting now, you've gone to sleep, you're underwriting the transaction. Adopt a continuous, data monitoring driven credit aspect of that is what you need to do. Because you've done underwriting, you've gone to sleep. If you remember, I said that if your score at origination, which you've done, is let's say A, in the process, you should have a calibration that we score our customer every time. The life cycle of the loan, the customer can be B today, can be C tomorrow. So that is an idea of adopting a continuous credit decision monitoring. So I think that's one thing I can say. I think you said just one, right?
Okay, probably you can give me more later. I'm really interested.
No, no, let
Okay,
me give them just one.
okay. So looking ahead, do you think the Nigerian lending space will ever achieve a fully data-rich environment, or will we always need to innovate around limited credit data?
Okay, so the progress is clear in Nigeria. The progress is clear. The progress might be slow, but we are moving little by little. But the Nigerian space will one day eventually achieve, a fully data-rich environment. However, let's just be realistic. There will be continuous innovation in the credit limits, the credit space. Every company will keep innovating. We keep innovating within this limited credit data space. However, not to remove the fact that the progress is there, and you'll be shocked that if you go back to 2004, I remember 2004 when I was doing a project. I think no 2012 when I was doing my MBA. Nigeria Bureau Statistics. If you go to their site back then, you would not see anything. You hardly even see a lot of data. But now, if you go there, there are a lot of data there. So the progress is clear. We are moving. Might not be fast enough, but we are moving. So that'll be all.
All right. Finally, before our Q&A, hope you all have your questions ready. How can lenders stay competitive while still being responsible in their credit growth?
Okay, so before I answer that question,
Okay.
I would say that I've been opportuned to work in different space. I've been opportuned to work in a technology-driven space. I've been opportuned to work in a traditional-driven space, and because I've seen both sides of the coin, it makes me realize that you should understand your target markets and understand your quote and unquote your power. So while going back to the question, the first thing I'll say is grow with precision and not aggression. If you are looking at the likes of some companies in Ikoyi, which I'll not mention the names, and you want to grow, saying I want to be like them, and you would run for your money because over time they've grown. So you would see that there are a lot of things you need to do back end. Another thing also is like I mentioned, speed and accuracy. Everybody is in the field of lending, and what you need to do is how fast can you lend to this customer, and how well can you lend to this customer without error. So your service delivery should be there. And one another thing you should also do is be customer centric and not product centric. So customer centricity gives you the ability to understand the customer. This is the need of the customer. This is the reason for the customer taking this loan. This is the idea behind why I should create this product. Most often than not, institutions create products and say, oh, I need to create this product, and people key into it. However, you need to be more customer centric than being product centric. And like I mentioned, continuous monitoring, except if you don't do continuous monitoring, you end up giving out loans and you end up saying, "Oh, I disbursed 1 billion today. I disbursed 10 billion today." After disbursing, you go back and say, "How many came back?" So that's another thing. And lastly, build long-term relationships with your customers. If you can build long-term relationship with your customers, is very good, and and you can also build relationship with your competitors as well. Trust me, it goes a long way. So that'll be all. Thank you very much.
Uh, I noted something you said. You said grow with precision and not aggression. It seems someone else noted that down. That's Sheba. Thank you so much, Mr. Michael. So we'll
Thank
be
you.
moving straight into the Q&A. Please, you can start dropping your questions. I think I saw a
Oh,
question earlier from Stephen. Okay, let me go through it. Okay, so Stephen is asking, please, can you give me an example of such questions? I guess this question came out when we were talking about the psychometric test, talking about behavioral pattern for
okay.
borrowers. Yeah, so he's asking for example of such questions.
Okay. So if you can have like I mentioned, you infuse the questions into your application form. Like you can have a question that would say, would you be, if given if required to take a top up in 1 month after this loan is disbursed, would you take the top up loan? Customer would, for someone that wants money, would say yes. For someone that feels I have a reason for taking this loan, I say no. So that gets a score. And you can also say, it's a lot of psychometry. And you can ask a question in three places, but they are the same but different pattern. Like, oh, what color of cloth are you wearing? You say red. And if the color of your cloth is not blue, what color is it?
Okay.
You're expecting you to say red, but if you now say blue or green, so that means there's this form of this person is just filling the form without accuracy, without
Mm.
your data accuracy. So I think those are few of the questions, but I can always share a bit. Maybe after this webinar, I can send a bit of the questions, psychometric questions in place that might assist Stephen.
All
Hopefully.
right. I'd like that. And if you'd also like to have that, please just give me a thumbs up in the comment section. I'll share with you. Okay. We have another question. We have another question from Stephen again. Okay. What key data points do you consider when evaluating a borrower's credit worthiness for your credit scoring model? Thank you, Stephen.
Okay, so I said we cannot totally throw off credit bureau data. So your credit bureau data will talk about the historical data for the customer. That is one.
Mm-hmm.
Another key point you also need to know is the demography of such individual.
Okay.
And one of the things is you have to put in place the sectorial analysis. What sector does this person work? A few people will tell you if I lend to somebody in the telecom sector, there is high tendency this person will pay back. If I lend to somebody in the banking sector, there's high tendency this person will pay back. That is two. You can also look at the income of such individual in terms of their capacity to pay, and um, and that will give you also, that's another data point you can use in evaluating the creditworthiness of such individual. Four, in terms of demography, is the person getting close to retirement? What is the person's designation at work? What is the income level of that person? Is the person a low income earner, high income earner? Such. What is the education background of that person? These are few data points that can assist. And I think Stephen would even have to now pay me more to give him more data insights. But I have a few data points that you can put in place, and a lot of data points that can help you with in terms of your identity theft. Are you speaking with the right person? Repayment pattern, what kind of repayment pattern the person is giving you, and these are for post disbursement data points as well. I think I'll just stop at that.
All right. Thank you. Chioke, thank you for the thumbs up. I will share it with you. Okay, we have a question here from Samuel. Okay, for a startup with little funding for technology, that's startup is a lender. Okay, so for a startup with little funding for technology for credit decisioning that wants to go into buy now pay later and wants to disburse to both salary earners and non-salary earners in less than 5 minutes. I think there's a follow-up question. Okay, how can the startup effectively lend with low NPL? Okay.
Okay, so the first thing to do that is, you said for a startup with little funding for technology for credit decisioning. If you remember, I said when you when you I mentioned BCP and DRP, Business Continuity Plan, and the Disaster Recovery Plan. I mentioned that irrespective of you automating, leave 1% of it for traditional, should in case anything happens, technology fail. So if you have little funding for technology, for credit
Mm-hmm.
decision, trust me, Samuel, you can build your credit decision on as simple as it is on Excel. I have done it, I have automated it, and I still currently to have it. whereby you can assign scores to different demographics
Mm,
in terms of the name. So I've done it. It's easy. So you don't need technology for that, should in case you have little funding. However, then this will not give you a category in terms of if it's a salary earner, they have a better score than that of non-salary earners. And the reason for that context is because you are sure of the income of the salary earner will come in every month, depending on where the person work. For business owner, the income can fluctuate depending on the kind of business the person runs. And so with that, you would have a different score. But for business owner, you can decide to say that that business owner can have a huge income. This is where your credit scoring will now be differentiated into different demographics in terms of basic data, in terms of income data. For the business or for the business non-salary earners, that is, let's assume their business, you can now decide to say, how is their income coming in? Do they have a lump sum of income that comes in every month? You know, these are the few things that you can do. However, I can tell you that your credit decision, you can do it on Excel. In fact, before machine learning, before every other thing, the calculation was done on Excel. And you find out that it's this same thing you've done on Excel spreadsheet that you can put into your CBA and say, oh, run this, and your machine learning will keep, predicting. Is a predictive model. We keep predicting the next thing to do. And all. I think I've been able to answer a bit of Samuel's question.
thank you so much. And Samuel, don't forget to grow with precision and not
Not
aggression.
aggression.
Yeah. Okay, so we have another question here from Chioke. In your experience, what is the most effective way to handle customers who have defaulted in their loans?
So I'm going to put this in three phases. Customer
Okay.
that doesn't know about the FCCPC guideline or CPD guideline. Customers that
Okay.
know about them, and customers that don't know about them, but you cannot quote and unquote, let me use our Nigerian parlance language, bogo them. They know the calculation. So let me start with customer that doesn't know about the FCCPC guideline. Default is imminent in many customers, and so one of the key things that I mentioned earlier was, early trigger signs, or whereby you contact the customer pays and all. If the customer is a salaried earner, it's easy. Is almost easy for you to get back the loan. As long as the customer is a salary earner, you write to the HR. If permitted, you can. That's why it's always good that when you are developing your loan application form and your offer of terms, please put it there that you consent to the fact that I can contact your employer, I can contact this, I can contact that. Because when you do that, the customer cannot come back and hold you responsible and say, you were not supposed to do this, you're not supposed to do that. But the customer's consent to such. So those are for customers that can get. So it's easy for you to get for salary earners. But for the ones that know the FCCPC guidelines and you don't have that consent in place, it might be quite difficult. But for such persons, you can also recover from them as long as you have your data points, you have the location, you have where the customers. I'll give you an example. There was a time, one of the places that I worked, Rosabon, there was a time a customer was defaulting, and I happen to know the customer I happen to know where the customer stays, and I knew the customer wasn't staying far from where I stayed. First thing I did was go there very early in the morning, around 6, when I knew the customer would be going to work, and I went there. You know, and most of these customers, they hate the fact, they don't like the fact that you want to disgrace them. So when I got there, I told the customer, I'll go shout to the customer, like, calm down, that's one. So you visit them, you just call them and say, you know what, I'm coming to your office. When you get to their office, if it's an office you can go in, when you get to their office, they get scared like, oh, Are you coming to tell the HR and this and that? But there are some that they don't even care. Just know that those ones you are in for it. And there are some that they know the calculations. They're helping you to calculate the interest rates, the default rates that you put. They are calculating it. That by 11:59, I made this payment, but your system is saying 2 o'clock. Why are you charging me default? I paid it 11:59. I say okay. My own system time, by the time I made the transfer, it left 11:59 from my own account, and so I'm not supposed to be charged
Oh my
default.
God.
It now went to you got to your own account by 12:01. Why am I being charged default? This is my own receipt. I sent it. So there are some customers like that. So you need to understand the type of customer first. And, and let me give you one trick. The trick is, I believe some customers are here. The trick is look at the demography of your customer.
Okay.
When you look at some customers and you look at this customer works in, or this customer works in quote unquote in manufacturing firm or a construction firm, he earns this, his age is this, and when you pick your phone, you say, oh God, I beg, just know that you can finish that one. Just know that you can you are here. Or when you are here, hello, how are you doing? I know you, I just be calm with that one because they'll start giving you the policy guidelines. So those are a few things you can put in place. But be just know what you're doing and know when to draw the line. Let me just be
Mm.
like, just know when to draw the line because litigations can come in from different places. So I think that's just what I can say about that.
All right. Thank you so much. Samuel and Choki are asking if they can get the Excel sheet you talked about.
We'll think about it.
Okay. We'll
They
think
should
about
contact
it.
Vin. So
Okay.
Vin will get in touch with them.
So you can contact us for the Excel sheet. Thank you so much. I don't see any more questions here.
So thank God I'm free.
Okay, in the absence of none, in fact, I've really um, enjoyed this discussion. It was rich, it was enlightening, it was informative. Thank you so much, Mr. Michael, for sharing such practical and actionable insights. So, if there is one key message I am taking away, it is that even in limited credit data environment, lenders are not powerless. With the right strategies, combining alternative data, smarter automation, and proactive portfolio management, we can reduce risk, improve recoveries, and still grow sustainably. At Vind, we are deeply committed to supporting lenders in achieving just that, building responsible credit growth even in tough data environments. Today's conversation is part of our ongoing effort to bring the industry together to share knowledge and practical solutions. Thank you again to our guest speaker and to all of you for joining us. We hope you leave with fresh ideas and strategies to apply in your organizations. Until next time, stay innovative and stay responsible. Have a wonderful day. Thank you.
Thank you, everyone.